What if I told you that Bitcoin could be sitting at $1 million within the next 10 years? And yet right now, in this exact moment, it feels almost boring to own. Not because Bitcoin is failing, not because the big institutions have given up, not because some government somewhere just banned it again, but because the loudest voice on Wall Street's crypto desk just said something that should make every single person watching this video stop and think twice about what they expect to happen next. Before we go any further, a quick and honest disclaimer. Nothing in this video is financial advice. I am not your advisor, I'm not a planner, and I am definitely not telling you to buy or sell anything. This is research, perspective, and a conversation about where the money seems to be moving. What you do with that information is entirely up to you. And if you're new here, welcome to the Wealth Continuum. This channel exists for one reason, to help you understand where capital is flowing before the rest of the internet catches up to it. If that sounds like something you want in your life every week, go ahead and hit subscribe before we dive in, because today's story might be one of the strangest and most important shifts we have covered all year. So here's the setup. Just yesterday, the chief investment officer at Bitwise, a man named Matt Hougan, said something that quietly contradicts almost everything retail investors have been trained to expect from crypto. He said the next bull market is going to be slower, less explosive, less violent, and honestly, less fun for anyone who got into Bitcoin chasing the kind of overnight life-changing gains this asset has produced in the past. And yet, in the very same breath, he reiterated something enormous. He still believes Bitcoin is going north of $1 million within the next 10 years. So how does that even work? How can an asset become one of the most valuable things on the planet while simultaneously becoming less thrilling to hold? That paradox is exactly what we are unpacking today, and by the end of this video, you're going to understand something most people scrolling past headlines completely miss. Let's get into it. Right now, as of this week, Bitcoin is trading somewhere around $64,000. That number alone tells a story because Bitcoin is currently down roughly 26% for the year, and it is sitting almost 50% below the all-time high it reached back in October of 2025, when it briefly touched above $125,000 per coin. Let that sink in for a second. Half. The price has been cut nearly in half from its peak less than a year ago. If you bought near the top, I know that stings. And if you're one of the people who held through this entire stretch without flinching, comment below and tell me how you're holding up right now, because I genuinely want to know who's still here after a year like this one. The broader sentiment data backs up exactly how rough this stretch has felt. The Fear and Greed Index, which measures the emotional temperature of the crypto market, is currently sitting at 22. That places it firmly inside what analysts call extreme fear territory. Trading volume across major exchanges has been thinning out too. In May alone, global exchange volume dropped by roughly 3.5%, falling to about $4.41 trillion, which happens to be the lowest level recorded since September of 2024. So no, this isn't your imagination. The mood out there really is this quiet. Really is this uncertain. Really is this slow. But here's where it gets interesting, and stay with me because this is the part most headlines are skipping right over. Despite all of that fear, despite the drawdown, despite the silence, Matt Hougan says interest from the people who actually manage serious money has never been higher. He's specifically talking about registered investment advisors, the professionals who guide high net worth clients and institutional capital. According to Hougan, their engagement with Bitcoin right now is, in his own words, as high as it has ever been. Read that twice. The price is down. The mood is fearful. Retail attention has wandered elsewhere. And yet the professionals quietly advising serious money are leaning in harder than ever before. That is not the behavior you'd expect during a typical crypto winter. So what's actually going on underneath the surface? According to Hougan, part of the answer has nothing to do with Bitcoin itself failing to deliver. It has to do with where the world's attention has wandered off to. Investors who once treated crypto as the only exciting frontier in finance now have an entirely different obsession competing for their dollars. And you already know what it is. Artificial intelligence. Think about how differently the financial conversation sounds today compared to just a few years ago. Back during previous Bitcoin cycles, crypto practically owned the spotlight. Every dinner conversation, every headline, every speculative dollar seemed to find its way into digital assets because there simply wasn't anywhere else as exciting to put it. That is no longer true. Artificial intelligence has become arguably the single largest investment theme on the planet right now. Massive amounts of venture capital are pouring into AI startups. Governments are funding it directly. Public companies are restructuring entire strategies around it. And every speculative dollar that used to flow exclusively into crypto now has a very loud, very shiny competitor pulling it in a different direction. Hougan put it plainly. In his words, the industry has lost the attention of investors to other hot trends, and right now, AI is the biggest one of all. That single sentence might explain more about Bitcoin's sluggish year than any technical chart ever could. And it's not just artificial intelligence pulling at investor attention either. Quantum computing keeps showing up in headlines. Robotics companies keep raising massive funding rounds. Space technology firms keep grabbing front page coverage. A handful of years ago, Bitcoin barely had to share the spotlight with anyone. Today, it's standing in a crowded room full of equally loud, equally shiny competitors, all fighting for the exact same speculative dollars that used to flow almost exclusively into crypto. Hit like on this video right now if you've noticed your own social feed shifting away from crypto talk and toward AI talk over the last year, because I think that shift alone tells us more about market psychology than any chart could. Quick pause here, because I want to check in with you. Are you watching this on a lunch break right now, scrolling before bed? Or are you actually sitting in front of your charts, watching this play out live? And while you're typing that out in the comments, tell me how the weather is where you are too. Because I read every single comment on these videos, and I like knowing who's actually on the other side of the screen with me. All right, let's keep going, because this is where things get really concerning for anyone still trading off old assumptions. Here's what a lot of people are not fully internalizing yet. The competition for attention isn't the only thing reshaping this market. The actual composition of who owns Bitcoin has changed dramatically, and that changes how price behaves at a fundamental level. A few years ago, Bitcoin was largely a retail-driven asset. Emotional buying, emotional selling, massive swings driven by fear and greed cycling back and forth at lightning speed. Today, a meaningful share of Bitcoin sits inside spot exchange-traded funds, corporate treasuries, and institutional portfolios managed by people who do not panic the same way retail traders do. We actually saw a small but telling signal of this just this week. After weeks of outflows from Bitcoin ETFs, inflows quietly turned positive again, with tens of millions of dollars moving back into major funds like IBIT and FBTC in a single day. That's not a dramatic flood of new money, but it is a signal that the institutional plumbing underneath this market hasn't abandoned ship, even while the price action looks ugly on the surface. Large allocators don't trade like someone refreshing an app every 6 minutes. They build positions methodically. They think in years, not days. And when an asset becomes dominated by that kind of long-term thinking, violent boom and bust cycles tend to soften, not disappear completely, but soften. That is precisely the dynamic Hougan is pointing to when he predicts a slower, less volatile bull market ahead. Less retail mania, more patient accumulation, less chaos, more structure. You need to understand this next part before I show you what's actually changed underneath the surface of this entire market. Spot Bitcoin exchange traded funds didn't just open a new door for institutional money, they completely rewired who's even allowed to walk through it. Before these funds existed, owning Bitcoin meant setting up a wallet, securing private keys, and trusting yourself not to lose access to your own money. Most pension funds, most conservative wealth managers, most retirement accounts simply weren't built to handle that. Now, exposure to Bitcoin sits inside a regular brokerage account, right next to stocks and bonds, accessible to the exact kind of long-term allocator who would have never touched crypto directly a few years ago. That single shift expanded the pool of potential buyers enormously, but it also changed the personality of the buyer. Retirement planners, family offices, wealth managers building portfolios for clients who think in decades, not days. These are not people who panic sell on a red candle. They tend to hold through volatility because that's literally their job description. And the more of Bitcoin's ownership shifts into hands like these, the more that old boom and bust personality starts to fade into something steadier. There's a strange irony sitting right in the middle of all this, and it's worth saying out loud. The very same institutional adoption that Bitcoin bulls spent years begging for might be the exact thing quietly killing off the explosive rallies those same bulls got addicted to. Subscribe if you want to see exactly how this institutional shift keeps playing out over the coming months, because this channel tracks these flows every single week, long before they show up in mainstream headlines. Now stay with me here. Because there's a second force at play that almost nobody outside the industry is talking about, and it might be just as important as the AI competition story. Stablecoins. The total stablecoin market recently hit an all-time high, crossing roughly $322 billion in total value. And according to financial giant Citi, the figure could balloon to as much as $4 trillion by the year 2030. Why does that matter for Bitcoin specifically? Because Hougan believes stablecoins, along with the tokenization of real-world assets like bonds, real estate, and private credit, are pulling a meaningful slice of institutional curiosity away from pure speculation on Bitcoin's price and towards something that feels more tangible during uncertain times. In his own words, during bear markets, when doubt is swirling, it becomes easier for investors to reach for something that feels concrete. Stablecoins and tokenized assets feel more grounded to most people than a volatile digital currency, even one as established as Bitcoin. So, here's the uncomfortable question worth sitting with for a second. Is the rise of stablecoins and tokenization actually competing with Bitcoin? Or is it quietly building the financial infrastructure that makes Bitcoin's eventual $1 million future even more believable? I'll let you chew on that because there's a strong argument for both sides, and I'd genuinely love to hear which one you land on in the comments. Comment below if you think tokenization ends up being Bitcoin's biggest rival or its biggest reason for finally going mainstream. Because honestly, the more research I do, the more I think most people are picking the wrong side of that argument. There's another piece of this puzzle that almost never gets airtime outside of institutional research desks. It's called real-world asset tokenization, or RWA for short. The basic idea is simple enough. Take traditional financial instruments, things like government bonds, real estate, private credit, and corporate debt, and represent ownership of them directly on a blockchain. For a lot of large financial institutions, this concept is far more practical than chasing the next speculative crypto narrative. Instead of trying to understand meme coins or trading volatility, banks and asset managers are quietly experimenting with tokenizing assets they already understand deeply. That creates an entirely separate channel of demand for blockchain technology, one that has very little to do with Bitcoin's price chart on any given day. According to Hougan, this expanding interest in tokenization helps explain why institutional capital looks like it's spreading itself across multiple corners of the crypto industry, instead of concentrating purely on Bitcoin the way it might have a few cycles ago. The industry as a whole is still growing. It's just growing in more directions at once, and that diversification is part of why any single asset, even Bitcoin, might not move quite as violently as it used to. Now let's talk about the number everyone clicked on this video to hear about, $1 million. Hougan's logic isn't pulled from thin air, and it isn't hype for the sake of headlines. It's actually built on a fairly specific framework around what's called the global store of value market. This is the combined pool of assets that wealthy individuals, institutions, and even central banks use to preserve and protect wealth over long periods of time. Historically, that role has been dominated by gold and government bonds. According to Hougan's analysis, that store of value market has already ballooned from roughly $2.5 trillion back in 2004 to somewhere between $38 and $40 trillion today. Bitcoin currently represents only about 4% of that massive pool. Here's the part that makes the math feel less impossible. If that global store of value market keeps expanding at anything close to its historical pace, Hougan projects it could reach somewhere around $121 trillion within the next decade. Under that scenario, Bitcoin would only need to capture about 17% of that expanded market to justify a price near $1 million per coin. Not 50%. Not total dominance over gold, just 17% of a pool that keeps growing larger every single year. And here's a detail that almost nobody brings up. Hougan's predictions actually go even further out on the timeline. In an earlier memo this year, he floated a long-term figure of $6.5 million per Bitcoin within 20 years, built on the idea that global government debt keeps expanding and currency debasement keeps accelerating. The core assumption there isn't even about crypto adoption speeding up. It's about the world continuing to behave roughly the way it has for the last 15 years. Stay with me, because this next part matters more than the big, scary number itself. Bitcoin's supply is permanently capped at 21 million coins, and almost 20 million of those are already in circulation. No central bank can print more. No government decree can expand that number. Every new buyer, whether it's a pension fund, a sovereign wealth fund, or someone watching this video right now is competing for a slice of something that mathematically cannot grow larger. That fixed scarcity is the entire foundation underneath the $1 million thesis. It isn't about hype cycles or social media excitement. It's about a hard ceiling on supply colliding with a slowly, steadily expanding pool of global demand. Here's what they're not telling you in most of the headlines chasing clicks with this story. A slower bull market isn't necessarily bad news. In fact, it might be exactly what allows Bitcoin to actually reach a number like $1 million in the first place. Think about it from a completely different angle. Wild speculative bubbles eventually crash, and crash hard. Violent rallies followed by violent collapses don't build the kind of trust that gets pension funds, insurance companies, and conservative wealth managers to allocate serious long-term capital. Stability does that. Predictability does that. Gold doesn't need to rally 500% in a year to remain one of the most trusted stores of value on Earth. Its steadiness is precisely what makes it valuable to the people who hold it for decades, not days. If Bitcoin is genuinely transitioning into a similar role, then becoming less explosive isn't a sign of weakness. It might actually be the clearest sign yet that it's maturing into something far bigger than a speculative trade. Here's a thought experiment worth sitting with. If someone offered you a guaranteed steady climb toward $1 million over the next decade, versus the old roller coaster of brutal crashes and euphoric spikes that might land you somewhere similar, but with far more stress along the way, which version would you actually choose? Be honest with yourself, because most people say they want stability, but their trading behavior over the last few years tells a very different story. But here's the part that should genuinely concern anyone watching this who lived through the last two crypto cycles. So stay with me just a little longer. Plenty of investors are still mentally prepared for the old version of Bitcoin, the version that rallies 300% in a few months, the version that creates overnight millionaires and then wipes half of them out just as fast. If the next cycle behaves the way Hougan is describing, slower, steadier, and built on patient institutional accumulation rather than retail mania, then anyone holding on to those old expectations could end up making some genuinely costly mistakes. Overtrading. Taking on leverage they can't actually afford. Panic selling during a quiet, grinding climb because it doesn't feel like the explosive moves they remember from previous years. The next cycle, if this prediction holds true, may end up rewarding patience and quiet conviction far more than it rewards speed or timing. So here's a question worth sitting with honestly before you keep scrolling to the next video. Are you actually positioned for a slow, grinding climb toward a much higher price over the next several years? Or are you still waiting around for the kind of explosive overnight move that this entire conversation suggests might not show up the same way again? I want you to actually answer that for yourself, not just nod along. Let's bring this all the way back together. Right now, Bitcoin sits around $64,000, down roughly 26% for the year, and nearly 50% below its October 2025 peak, above $125,000. Fear is dominating the mood, with the broader sentiment index sitting deep in extreme fear territory. Attention has genuinely drifted toward artificial intelligence, pulling speculative dollars away from crypto the way crypto once pulled them away from everything else. And yet, underneath all of that, institutional interest from serious financial advisors has never been stronger. Stablecoins just hit an all-time high above $320 billion, with Citi projecting that figure could reach $4 trillion by the year 2030. Real-world asset tokenization is quietly building financial infrastructure that didn't exist a few years ago. And the man overseeing one of the largest crypto-focused asset managers on Wall Street still believes, with real conviction, that Bitcoin crosses $1 million within the next decade and potentially $6.5 million within 2. The next bull run, if this thesis plays out, may not look anything like the ones that built Bitcoin's legendary reputation. It might be quieter, slower, less dramatic on the surface, but underneath that calm exterior could be the most consequential wealth transfer crypto has ever produced, simply because almost nobody was positioned correctly for what it actually looked like when it finally arrived. If this video genuinely shifted how you're thinking about the next few years, that is exactly the kind of perspective the wealth continuum was built to give you week after week. So hit subscribe, tap that notification bell so you don't miss the next breakdown, and drop your honest prediction in the comments. What year do you think Bitcoin actually crosses $1 million? And do you think you'll still be holding when it happens? If you know someone who's still waiting around for the old kind of bull run, the kind built on chaos instead of patience, Send this their way. They might need to hear this before they make a decision they regret. I'll see you in the next one.